Let's talk about dependent tax deductions and credits for families. This is an important topic because if you are going to file taxes this year, you better make sure that you have a clear idea about every deduction, every single deduction and credit that your family could qualify for. Okay, so here's the overview I want you to pay attention to. So the child tax credit can reduce your taxes by up to $2,000 per qualifying child age 16 or younger. 16 or younger. If you don't owe taxes, up to $1,500 of the child tax credit may be refundable through the additional child tax credit. That's number one. Number two, if you adopt a child, you may qualify for the adoption tax credit, a non-refundable tax credit that allows you to claim a credit of up to $15,000 all the way to $17,000 for qualifying adoption expenses, and up to $15,000 to $70,000 in other circumstances. And if you or your dependent is pursuing a degree at a school, you may qualify for the American Opportunity Tax Credit, a partially refundable tax credit of up to $2,500. Okay, I'm just giving you, first of all, I'm giving you the shortcut here, and then I will just elaborate. Okay, now if you paid interest on qualifying student loans during the tax year, you might be eligible to deduct up to $2,500 of that interest with the student loan interest deductions. So let's first talk about family matters. So as a family with children, you may have access to more tax deductions and credits than taxpayers without children. If you're not aware of these deductions and credits, you may be missing out on some tax savings. I'm talking about some serious tax savings. And so if this is the first year that you are filing your taxes, you may not be aware of some of the recent tax changes that have affected taxes and deductions for families. And so let's first talk about the Tax Cuts and Jobs Act that changed how families get deductions and exemptions. So in December 2017, Congress passed the Tax Cuts and Jobs Act amid significant changes regarding how some tax deductions and credits work for families. Most of these changes took effect in the year 2018 tax year. And so you have removal of exemptions. So the removal of personal exemptions is one of the largest changes. And because before the 2018 tax year, you will likely receive the personal exemption for each qualifying member of your household. This may have included yourself, your spouse, and any qualifying dependents. Okay, so it was starting in the tax year 2018 and going forward, you can no longer claim personal exemptions. The removal of this popular reduction of taxable income may be partially or completely offset by the Act's other changes, depending on your particular circumstances. So you have the standard deduction increase. So the standard deduction really increased big time. Okay, and this year it will be the same. I will talk about other credits also. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So besides the standard deduction, you have the child tax credit and credit for other dependents. Let's first talk about the child tax credit. So the TCJA actually increased the child tax credit from the old $1,000 limits to now $2,000 limits, okay, for a qualifying child age 16 or younger. If you owe no tax, up to $1,500 of the new child tax credit may be refundable on using the additional child tax credit for this year. And children over age 16 are not eligible for the child tax credit. However, these older children and other qualifying dependents may be eligible for a new tax credit of up to $500 called the credit for other dependents. And dependents must be a U.S. citizen, U.S. national, or U.S. resident alien, so a green card holder. There must also be a qualifying child or qualifying relative. And so a qualifying child must meet the relationship, age, residency, support, and joint return test. A qualifying relative must meet the not a qualifying child, member of a household or relationship test, gross income test, and support test. So this is kind of important. Normally, if you use tax preparation software, you should be fine because they actually do it automatically for you. So you also have adoption tax credit. So if you have adopted or plan to adopt a child, you may be able to take advantage of the adoption tax credit. This non-refundable tax credit allows you to claim a credit of up to $16,000 to $17,000 for qualifying adoption expenses for adoptions finalized this year, and so the amount will go to $18,000 next year. And so it's really kind of handy because qualifying adoption expenses for eligible children include necessary and reasonable adoption fees, court costs, attorney fees, eligible travel expenses, and other direct expenses in relation to adopting a child. And eligible children must be under the age of 18 or be incapable of self-care due to physical or mental reasons. So this credit does not apply to adopting a spouse's child. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about dependent tax deductions and credits for families. Next, you have education-related deductions and tax credits. So education can be expensive, we all know this, and tax deductions and credits may offset some of this cost. And basically what's happening here is that you have the American Opportunity Tax Credit. So this American Opportunity Tax Credit is a partially refundable tax credit of up to $2,500. It can be claimed for qualifying education expenses for eligible students during the first 4 years of higher education. So you get 100% tax credit for the first $2,000 in eligible expenses. You also get a 25% tax credit for the next $2,000 of eligible expenses. So this credit is actually reduced if your modified adjusted gross income exceeds $80,000 for those filing single or $160,000 for those filing married, filing jointly. There are other requirements to claim this credit. You can claim the credit for each qualifying student on a tax return. And you also have the lifetime learning credit. So this is another option if you're not eligible for the American Opportunity Tax Credit. You cannot claim both this credit and the American Opportunity Tax Credit for the same student in the same year. Okay. Now the credit here is for up to $2,000 per tax year, but starts phasing out when your modified adjusted gross income exceeds 80 grand for single filers and 160 grand for married filing jointly filers. And this credit is not refundable. It's actually calculated by taking 20% of the first 10 grand in qualifying education expenses for qualifying students. You can only claim the one lifetime learning credit per tax return per year. You also have a tuition and fees deduction. This is for 2020 and earlier. And also you also have a student loan and interest deduction. So you might be eligible for the student loan interest deduction if you paid interest on student loans during the tax year. This deduction can be up to $2,500 for qualifying student loan interest paid. And so the deductions start phasing out at a 2023-2024 modified adjusted gross income of 75 grand for single filers and 155 grand for married filing jointly filers. And if your modified adjusted gross income exceeds 90 grand for single filers or 185 grand for married filing jointly filers, this deduction is not allowed at all. So this ranges actually increase for next year to 80 grand through 85 grand for single filers and 165 grand through 195 grand for joint filers. Let's talk about itemized deduction opportunities and changes. So itemized deductions could help your family claim more money in deductions than the standard deduction offers. So the medical expense itemized deduction may be especially useful for families with many qualifying medical expenses. Qualifying medical and dental expenses that exceed 7.5% of your adjusted gross income can be claimed as an itemized deduction. Now, suppose your family had high medical and dental expenses due to you, your spouse, or a qualifying dependent's accidental injury or medical treatment. In that case, this could help you claim extra deductions if you already itemized deductions. Unfortunately, if you don't have enough itemized deductions to exceed the standard deduction, you will not benefit from the medical and dental expenses deduction. So this is what it is. And before the 2018 tax year, itemized deductions could be limited if your income exceeded certain limits. That limitation was removed by the Tax Cuts and Jobs Act. You also have annual increases due to inflation adjustments. So each year, the IRS makes annual inflation adjustments to certain items. And this can help reduce your taxes owed compared to a scenario where the IRS didn't make inflation adjustments, okay? You also have other ideas. Let me just give you other ideas to save on your taxes. So families have other ways they may be able to save on the taxes. For instance, business owners could employ their children within their businesses. If you do, you may be able to take a business expense for the wages that you pay your child. Your child's income may also receive a relatively low overall tax burden as long as the wages stay under $13,850 standard deduction for this year and $14,600 for 2024 for next year. And if your children are in college, you may want to consider purchasing a second home in their college town. This may allow you to take advantage of the mortgage interest and real estate tax deductions for second homes on your tax return. You would have to itemize to take these deductions, as they may not provide much benefit depending on your situation. So make sure you run the numbers before doing so, okay? It's one of those things where you want to sit down and really run numbers and be sure that those numbers actually make sense for your family situation before you do anything. And if in doubt, if you are in doubt, always contact a specialist. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about dependent tax deductions and credits for families. Let me talk to you about the pro tips here. I want to give you a few pro tips. Let's talk about the rules for claiming a dependent on your tax return. Okay. Now, the thing here is that basically, for what is a dependent first? Let's talk about that. For tax purposes, a dependent is someone other than the taxpayer or spouse who qualifies to be claimed by someone else on a tax return. More generally speaking, a dependent is someone who relies on another person for financial support, such as for housing, food, clothing, necessities, and more. And typically this includes your children or other relatives, but it can also include people who are not directly related to you, such as a domestic partner. So once you identify someone as a dependent on your tax return, you are informing the IRS that you met the requirements to claim them as a dependent, okay? So this is important. Now, why claim someone as a dependent? Well, it really, because you're trying to really save on taxes. If you have a family, you need to know how the IRS defines dependents for income tax purposes. Why? Because it could save you thousands of dollars on your taxes. So basically, you have like exemption deduction that were replaced by an increased standard deduction, a larger child tax credit, a bigger additional tax credit, and a new credit for other dependents. So I'm talking to you about changes that really came into effect after the TCJA that really went into effect in 2018. And so dependence rules also apply to other benefits such as earned income tax credits, child and dependent care credit for daycare expenses, and medical expense deductions, various other itemized deductions, and most tax credits that involve children or family issues. So qualifying for these benefits can make the difference between owing money and receiving a refund. And so the basic rules are not complicated, but it can be very difficult to apply those rules to certain family situations. That's especially true if you have a son of a college, a cousin who stays with you during the summer, or a daughter with a part-time job. And so the questions that it really depends. I will give you a few questions that will really help you decide which relatives you can claim as dependents. So here's the first question. So what qualifies someone as a dependent? So the IRS rules for qualifying dependents cover just about every conceivable situation, from housekeepers to emancipated offspring. Fortunately, most of us live simpler lives, so the basic rules will cover almost everyone. Here is how everything breaks down here. So there are two types of dependents, each subject to different rules. So you have a qualifying child and you have a qualifying relative. Okay, and for both types of dependents, you will need to answer the following questions to determine if you can claim them. So are they a citizen or resident? Because the person must be a citizen, a U.S. national, U.S. resident, or a resident of Canada or Mexico. And many people wonder if they can claim a foreign exchange student who temporarily lives with them. The answer is maybe, but only if they meet these requirements. Are you the only person claiming them as a dependent? Because you cannot claim someone who is claimed as a dependent on another tax return who states that they are not able to be claimed as a dependent on their own tax return, takes a personal exemption for himself or herself, or someone who claims another person as a dependent on their own tax form. So this requirement commonly applies to children of divorced parents. So there are certain tiebreaker rules which are basically found on the IRS website, especially in Publication 501. So these rules establish income, parentage, and residency requirements for claiming a child. And the third question is, are they filing a joint return? So you can't claim someone who's married and files a joint tax return. Say you support your married teenage son, right? If he files a joint return with his spouse, you can't claim him as a dependent. The rule doesn't apply if the dependent files a joint return only to claim a refund of income tax withheld or any estimated tax paid. Now let's talk about qualifying child. In addition to the qualifications that I just said, to claim a qualifying child, you must be able to answer yes to all of the following questions. Are they related to you? Do they meet the age requirements? Your child must be under age 19, or if a full-time student, under age 24. There is no age limit if your child is permanently and totally disabled. Do they live with you? Your child must live with you for more than half the year, but several exceptions apply. Do you financially support them? Your child may have a job, but they cannot provide more than half of their own support. So when we talk about are they related to you, the child can be your son, daughter, stepchild, eligible foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, adopted child, or an offspring of any of them. Okay, so those are really one of those things where you have to really pay attention to how the whole situation applies to your specific situation. Okay, and so there are examples of claiming dependents, like married filers with 2 minor children, divorced filers with 2 minor children, multiple siblings supporting an elderly parent through a multiple support agreements, or claiming a domestic partner. In every situation, please let us know in the comment section, and we'll get back to you. We'll answer you based on your specific situation. Let's talk about deductions and credits available when claiming dependents. So first of all, you have earned income tax credits. So this is the largest financial support program for working people with low to moderate income. The refundable tax credit works by reducing income tax and often increasing tax refunds for low to moderate income taxpayers, and can amount to as much as $7,500 for a family with three or more children for this year. So to receive the credit, you don't necessarily need to have children, but the credit amount is typically higher for those taxpayers who have qualifying children. You also have child and dependent care credit. So this refundable tax credit helps parents pay for daycare for a qualified dependent while working, going to school, or if a parent is unable to care for themselves. So the credit amounts to between 20% and 50% of up to $6,000 of expenses for this tax year. You also have child tax credit and additional tax credit. So this is really wonderful. Also, you have also credit for other dependents. You have adoption credit that I just spoke about earlier. You have medical expenses. So if you paid for medical expenses for your qualifying child or relative dependent, you may claim those as a deduction, subject to rules around the medical expenses deduction. So generally, this means that you can deduct your qualified unreimbursed medical care expenses that exceed 7.5% of your adjusted gross income. You also have the American Opportunity Tax Credit and Lifetime Learning Credit I just spoke about. So those two tax credits are meant to cover, as I said before, part of the cost related to qualified education expenses. So this can be for yourself, spouse, or dependents while enrolled in college, vocational school, or work-related training. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about dependent tax deductions and credits for families. So I gave you the overview and the pro tips. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.